Right. Yeah. Exactly. So you would look at.
It's just to better understand the value of the company.
Yes, on a per share basis. Yeah. So in our evaluation process, it means nothing. But just in terms of the measures, because even down here, there's going to be a lot of ratios that we calculate, and some of them would be utilized for the sake of projections. Some of them probably wouldn't be utilized at all, but they're all important to know. So these margins down here are just calculated, mostly as a percentage of sales. So gross profit is about 26% of sales. SG&A is about 18%. Depreciation and amortization is about 1.48%. EBIT is, so and so on and so forth. So we could utilize these ratios to help with our projections, over here potentially. You see what I'm saying? So just to give us a feel, but it's also the type of stuff that gives you a feel for how efficiently the business is running. So if you know that the average EBITDA margin in the industry, is 13%, they're only doing 7.9, then there's a problem there. And it's just little stuff that you'd be expected to know. Then stuff like the tax rate. So, balance sheet items. Cash and cash equivalents. Now you can see that we hit a sell, so it goes from B to D. So, cash equivalents, basically anything that's cash or that can be turned readily into cash, so like CDs, things like that. Accounts receivable, again, is money that is owed to, that's owed to the firm, usually within 60 days or 90 days. Inventories, whatever the firm is selling, whatever they have on hand. Deferred income taxes end up being an asset, and then other current assets. So for any company, there's going to be a ton of just other small random things, so you just put those in the current assets if they can be turned into cash within a year. So as far as other assets, property, plant, and equipment, net of accumulated depreciation. And so, depreciation is something where, it can kind of build up over time, so you can net that out against the current property, plant, and equipment. Goodwill is going to be something that an intangible item on the balance sheet that basically represents the price that was paid for a given asset over and above the market price. Or over and above its asset value. So let's say you buy a company that only has computers, but you buy it because all the people in the company are brilliant. So there's 12 people in the company, they're all brilliant. The cost of the computers is only $1 million, right? But you paid $5 million for the company, right? And you paid it because the people are brilliant. But there's really no way to record that in a technical way. So goodwill in that case would be $4 million because the assets of the company were only $1 million, recordable, objective assets. But you sort of paid over and above that. And what happens with goodwill is that it has to be periodically evaluated by outside accountants. So when you go to Deloitte or whoever to do your accounting, they're going to evaluate and say, were these 12 people really worth $12 million? The additional $4 million. And so they say now today, it's probably worth more like 2. Then that's another write-down you have to take. So now your goodwill goes from $818 million to $816. and you have to write that goodwill off in the income statement. Again, other intangible assets are listed in one category, and then other non-current assets. So stuff that cannot be that cannot be turned into cash within a year, but at the same time, is considered to be an asset. So on the liability side, you got accounts payable. Again, money that you owe to people outside of your company within the next year, usually within the next 30 to 90 days. Accrued expenses would be expenses that you accrued but have not paid. Short-term debt is obviously debt that's due within a year or less. That's the definition of short-term. The current portion of long-term debt, there's going to be a certain portion of long-term debt you have to pay within a year. So that's also listed as a short-term liability or current liability. Long-term debt is obviously debt that's due more than a year out, and then other long-term liabilities are kind of grouped into one category. So when we look at shareholders' equity, we're just looking at sort of a reconciliation, of the rest of the balance sheet. It has balance, and so in this case, these are specific numbers for CBS that are probably going to be pretty much close to the same now. You're looking at about $267 million in preferred stock. Again, that's the preferred stock. You got the special dividend on the income statement. The amount of treasury stock out there is going to be roughly, it's going to be stock that the company actually holds as a company. There's going to be something that's set aside for the employee stock option program. Retained earnings is going to basically represent money that was reinvested in the business, profits that were reinvested in the business. And the capital surplus is going to represent funds that were raised since the company did their initial capital raise. So, or money raised above par, basically. And so, yes.
What is 0.1 par and par 1?
Well, par value is almost like, it's sort of like a, they have to give a number for the basic value of the shares before you kind of sell them to someone else at some mutually determined value, right? So they can't say, until somebody tries to pay for these stocks, they're worth nothing. So they give a number that's really like less than a penny. So every share is worth like less than a penny. So the actual par value of the stock, if it was not sold, for something like this, if it's preferred shares, it would be like $267,000, right, for a multi-billion-dollar company. But the actual value is what they sold it for, But in order to make everything balance, like for instance, the capital surplus, basically what the company brought in over and above par, in order to make it balance, it kind of has to take into account that, it almost has to make those shares zero to start. And then, we brought in X amount from selling X amount of these shares for X price. Does that make sense?
So par 1 would mean?
Par 1 would theoretically mean that, the stock sold for $1. Well, or par value was $1, and they'd sell it for some amount, theoretically above that.
So it's an arbitrary number.
You can think of it as